Okay, guys, welcome back. This is going to be a closing market analysis. So again, this is the Fed week. We've got the Fed coming out on Wednesday, and there's likely going to be some volatility involved with that. Now, we're expecting a 25-point rate hike. That's kind of what's priced in. Maybe there's going to be more. If we get a 50% rate hike, kind of a half a point, we might see some strong downside selling. Okay, so what we want to start off with today, though, is just kind of figure out where we ended up and look at some individual trade ideas. Guys, if you're new, drop me a thumbs up. Also, check out my stock market technical analysis course. I put that course together for my subscribers at their request, and I priced it appropriately so it's affordable for all. Okay, so check that out. That should help you with additional skill set that you really need to learn these skills in order to become profitable, basically. So link in the description below. All right, guys, triple Qs closing at the lows. Here's the recent lows right here. Let's go to the hourly chart just to narrow that down. So there's your lows. This was back on February 24th, and we basically there was your lows right there, and you can see we closed just slightly below. After hours looks like they're trying to pop it back up, pretty much at the lows right there, the former lows. Okay, so we need to take those out. If we take those out, and that might come in the form of a gap down tomorrow, I don't know. It can go either way from where we're at right here. We could bounce again, and then maybe on Wednesday after the Fed comes out, sell off. There's a lot that can happen in the short term. But if we take out the lows, flipping back to the daily chart now, then we should head down to our profit target. All right, and that's going to be right there at 300. Okay, still have bullish divergence. That still remains. Look at the PPO. It's kind of barely hanging on. Let me blow that up. There's the PPO. There's your bullish divergence, but you can see PPO is pointed downward, headed straight down. So if that continues to go down, we're going to take out the PPO and divergence, and it's going to look something like that. And at that point, you'll have burned through bullish divergence, and it's just extremely bearish if you have divergence and you burn through it. It doesn't happen very often, but if it does, it's just going to indicate that we're likely entering something a lot longer time frame, and we're likely entering that bear market. RSI is pointed down as well. So we have a new lower low, just barely today. It did kind of dip down, but we still have that bullish divergence. So again, if we see really impulsive selling anytime soon, or just kind of a continued wave of selling, and we take out the divergences, I just want to reiterate that that's going to be extremely bearish, and we're likely in for a lot longer term and a bigger bear market than what's in the charts as of right now. All right, IWM, this is small caps closing kind of at this support level that I had. Now we have these former lows right here, but I marked this level out because we did get some reactions right in here. It's about 192.97, and that's basically where we closed at, but we got the lows down here. So I suspect tomorrow we're probably going to head down to the lows and close down here. You can see we've had two reactions. There's a tag of that area, and there's another. So you head back down there, there's a likelihood we're going to break it. So things to watch for there on that. But again, anything could happen from where we're at right now over the next couple of days. We could rally. We could see another little rally and then sell off. I don't know what's going to happen in the short term. Medium to longer term still looks like it's priced in the charts that we're going to head down to the profit target. So I keep talking about this day in and day out, just because by the time it actually does it, the money will have been made. If it starts to make that move, the money's going to be made already. So it'll be too late to jump on board. If you start seeing that move down there. So I just want to point it out in advance. And again, we're just looking at this bear flag. Here's your flagpole. You got a flag that's kind of defined within this kind of sideways action, and then you mark the flag like that, and that sets us up for a move down to 170 area. All right, so that's the projected target. We should get there. It should be pretty impulsive of a breakdown, so I would think we'd maybe gap down and start to sell down. And that would make sense, because if people aren't short now, a lot of the time, the market likes to deny you a perfect entry. So if you haven't shorted, a lot of people are probably waiting for a break of this 188 area. But the thing is, what it will do oftentimes is gap down, and then by the time it opens up, you don't really want to short on a gap down. And if you're long, a lot of people are saying, okay, I don't need to sell until, as long as it's holding this level. And if it gaps down, it kind of traps them into their losses and they start to become sellers. Qualcomm. So Qualcomm worked out very nicely today. It was selling off, down 7%. I don't think there was any real news. It's just built into the technicals. All right. The chart told me that this is where Qualcomm was heading. So again, this trade's been in play for a while. I've been shorting this for a while. But again, I was shorted it up here at tags of this resistance level at about 192. And, sold down about 27% gain on that one. There's a gap fill right here, and you can see it didn't quite fill the gap, and that's exactly what I was expecting, to not completely fill the gap. I did cover my short trade on this today, so I am no longer short Qualcomm. Now, if we get a bounce back into resistance, I might look at shorting it. But again, the trade's already started to work out very nicely, so no reason to always chase a trade if you've already got a nice gain on it. And the goal was to come down and gap fill right there. So you can see I talked about how I was going to cover the trade if we got really close to that gap, and that's exactly what we did. So covered the trade, out of that one for now. Could bounce here, could continue to break down. I don't know which way it's going to go. Ultimate target, I still think Qualcomm has a very high probability to head down to some of these lower targets, but I think we could get a bounce here. The next area of good support is about 123.28. That's really good support. You can see all the tags of support right there. Kind of a gap right in there. It was resistance right there. It was support right there. Lots of reactions. So that's a really good level. I would put, decent odds that we, at a minimum, head down there before experiencing a relatively sizable bounce. But we could get a little bounce on this gap fill. It's something to watch for. And then there is a gap all the way down here at 94. Big gap right back there. So the way that I think it'll go is maybe we get a bounce here, bounce up to resistance, then come down, break down, hit that, maybe chop around here for a little while, probably run up to the high, chop around. It'll probably hold that level for a decent amount of time, then finally break down, little reaction there, and then head down. All right, that's going to take time. That's going to play out over probably months, but that's what I think is probably going to happen. Okay, Apple closing below the 200-day moving average today. So that's bearish in general. You got the largest stock in, largest company in the world, I believe, or at least it used to be, and the largest stock in the S&P 500 and really in the broad market. And it closed below the 200-day moving average. So the algos and everything that are programmed to buy the dips at the 200, you can see that's exactly what they did here. First tag of the 200, they bought it up. But when it came back down to the 200, it was starting to look obvious that it was likely going to break. And today it broke with a gap down. Gap down, they tried to recover it, but ultimately the selling just continued. So it's likely, Apple's likely in sell the rip mode at this point, where we're going to continue to see rallies get sold into as it continues to downtrend. Now, Apple has a support line right here on the daily chart. You can see all the tags of support, and we're really close to approaching that. So maybe a little bit more downside, and we might get a bounce, but probably back up to the 200-day. But ultimately, if you see it break this level here, the support line, and right now it's at about 148, 149, we'll call it. You see it impulsively break, especially with like a gap down. And that's likely setting us up for, a pretty good sized move to the downside. Okay, at that point you would have broken that support. So that's your next sell signal. All right, so it's not objective to short Apple right here, because we're still above that support, but you break down and you get that next sell signal breaking that trend line, and that's just going to be another logical reason that we're entering a bear market, to see the biggest stock breaking support. And I read something on CNBC, some article talking about how Intel was a deep value stock, and I think it's just hilarious how they frame their arguments. It's clearly geared towards the uneducated or uninformed, I guess. Not necessarily uneducated, but uninformed. All right, so Intel was in a bull market. This is a weekly chart on Intel looking at 2009. Clear uptrend since 2009. So that's your bull market since the Great Recession in Intel. Broke once. We broke that bull trend once. They recovered it, all right? And this was back in 2020. The Fed was pumping money. They were buying it. All dips were being bought across the board. But you can see we broke it again. Broke it. It drifted sideways. Big impulsive breakdown. Back test right there and a clean rejection. Now we're heading down to what looks to be a major level of support, 43.64. You can see all the reactions that we've had. There's one, there's another. And this is a weekly chart, so this is a big level. We're heading back down to there. And as I zoom in, recently you can see we just hit it on the weekly right there. Bounced, but we're almost right back at it. So it's looking pretty weak. It keeps, we just keep kind of tapping on that support level. And the more tags of it, the higher probability that you're going to break. All right. I think this will break. All right. I don't, the next sell signal will come on a weekly breakdown of this support line. But if you get that, it's just telling me that we're likely entering a bear market in Intel. All right. And you've got a good level of support right here at 38. So you break that level, again, 43.69, about 43.50. You get a breakdown there, we should sell down pretty quickly, right down to that 38.01. And that would be a drop of about 13%. All right, so there's a trade idea. Not actionable yet, but, keep an eye out for that breakdown. That could be good for, 10% or so. Okay, I want to point out something that, bigger picture, but it is kind of scary. LQD, this is investment grade bonds, okay? So this is at your Apple bonds, your corporate bonds. This is it's not your federal government treasuries. This is your corporate bonds, all right? But investment grade. So, good companies basically. And you can see the investment grade bonds are pretty much in almost free fall. They've just about gone parabolic to the downside. That's not good because ultimately, at the end of the day, a lot of the reason why the market has rallied, primarily because of the Fed over the last 12 years, the Fed's kept interest rates at zero, which has allowed the corporate sector to sell debt, to sell its bonds for very low rates. A lot of the time the rates are lower than what they're having to pay dividends on in terms of dividend yield. So what these corporations do, Apple, all the corporations, they sell the really cheap bonds and then they buy back their stock and they end up saving money, pumping the stock up and not having to pay dividends on that. And the debt that they sold was a lot cheaper. That's all pretty much been initiated by the Fed keeping interest rates really low. Well, we're now seeing the corporate bonds just pretty much collapsing. So that's going to put a end or at least a pause to the share buybacks that we've seen, which have really contributed to a huge amount of the market gains. So that's some fundamental things, but there's the technicals. You can see we're breaking down. We're almost just back out into the levels where COVID was crashing on LQD. So not looking good there. And then if you look at JNK, this is junk bonds, highly speculative, bonds, and you can see they're pretty much just collapsing too. The last 2 days have been very impulsive selling, and today being Monday, there was very impulsive selling on Friday, and they just followed it right up on Monday. That's usually pretty bearish when you see a Friday and a Monday have two strong sell down days. And again, the bonds continue to sell down. We're going to have problems. And this is what the the Federal Reserve cares most about, is the bond markets. Again, credit is what kind of keeps our economy afloat. It's a borrow and spend economy. GDP is 70% is consumer spending. So if you're not, if credit stops flowing, the market pretty much implodes. So I don't know what to make of that, but I do know that this is not bullish for the stock market and it's not bullish for the bond market. XLP, this is your consumer staples. So these are defensive stocks. this is stocks that are in the S&P 500, and you can see we have clearly broken trend. So there you go. Nice bullish up, or this is a bearish rising wedge pattern, but it is bullish price action as it's continued to grind higher. All these tags of support. Again, up at the highs, we had negative divergence indicating that, okay, we're likely going to break down. Sure enough, we got the sell signal. The sell signal, I think Friday was really the sell signal. Thursday just wasn't good enough. Friday, impulsive selling, closing at the lows. That's your sell signal. Today, a little bit of a kickback rally, but nothing technically, really breaking the fact that the sell signal is still in place. So at the end of the day, I would look for this to continue to sell off. Now, we do have the Fed coming out, so maybe they're going to, maybe this is a false breakout. But as far as I can tell, it's a sell signal. You want to take it at face value. We should sell down to the next level of support. I don't see support till about 68.71. All right, that's some support. All right, so that should be your next level of support right there. All right, more downside on that one most likely. Okay, GME, just pretty strong sell down today. I thought it was going to be down about 20% today. Ended up only being down about little under 16%. So a little bit shy, but I don't see any indication that there's not going to be more selling. And it's likely going to be impulsive. We'll probably gap down tomorrow and, maybe gap down near some support. But I would expect the selling to just come in and this should start to just, the bottom should really drop from this thing. So this at this point is likely going to be a wheelbarrow and shovel stock that's going to just continue to collapse, pretty much collapse on itself. It has no business being way up here. It was just pumped up here with stimulus money from retail traders. And, when you see it, when retail traders are taking losses in all their other positions, they don't have that kind of that no fear attitude, and they'll panic sell out of this stuff, and that's what we're seeing. So anyone that's been following along, I'm still looking for that $40 level before we get some sort of a bounce. This thing's likely probably going a lot lower. I don't know if they'll go bankrupt right now, but they're likely going to come back down into these longer term ranges down here. Maybe down here before it went parabolic, could get down to that $20 level. There's a lot of levels along the way, but I just don't see any reason why technically it shouldn't continue to hold up. It should go down technically because it's priced into the charts, and then fundamentally as well. So some of these Chinese stocks like Baba and JD.com, they're pretty much just imploding and just collapsing. So not anything that I'm really interested in right now. I just don't see an entry. I don't see anything technical that I'd want to get in on, but clearly just an implosion of price. So we'll look for a bottom in these, but I don't see it yet. Look at the divergence. We had bullish divergence on this, and it was there for a while, and it just burned through it, it looks like. Right there, and then on the PPO you can see right there. So we just kind of burned through, not quite. It's the divergence is just barely there, but any more downside and it's going to burn through that bullish divergence. It's just going to indicate that this is going to be in a bear market for a while. So that's that one. And then JD, here's JD. You can see, in just a period of a couple weeks, it is down to the lows 43%. It's just absolutely imploding. So again, and this one also had bullish divergence. You can see it started to build it right about there on the RSI, and it was on the PPO, but this was a divergent low and that was a divergent low. And so you had bullish divergence. It started to look good, started to look like it was going to break higher, and then just it absolutely imploded, taking out that bullish divergence. And you just don't have, you've got negative momentum, negative price action, just looking really bad. It's just, the market's not looking good here, guys. And here's another, just indication that I think we're entering a bear market. Clorox, just another example. Clorox, defensive stock. You can see here, clear uptrend line right here going back to 2010. There's your uptrend line, lots of tags of support. And on this weekly chart, big weekly sell signal, kind of a little flag, and just a continuation. So breaking that bull trend, breaking down, we got some support down here. Probably going to find some support down here in the 112, 113 area. But it's breaking that bullish trend and likely starting a bear market. It's already in a bear market in terms of percentage-wise. It is down from the all-time highs, down 46%. But this thing has a ways to fall. Could fall a lot more. So, the market right now is looking really weak, and there's a lot of potential for a pretty impulsive crash down to some of these targets that we have laid out. We're going to be looking to take profit on that move, and then we'll probably expect a bear market rally. But again, I reiterate, it continues to be a sell the rip market. When you see stocks rally, we look to sell into those. The only market I'm looking to buy the dip on is the gold miners, and they still continue to look okay, although they look like they're going to pull back a little bit. But again, we're buying the dip there, and we're selling the rip, especially in tech stocks, the tech sector. And mainly, for me, I'm really focused on some of the strong tech stocks like Apple, Triple Qs is a play on that. Tesla. I'm looking at the ones that haven't really started falling yet. I don't want to short the stocks like Snap and all that have already collapsed 60, 70%. I'm more interested in the generals, the ones that have been holding the market up and are just starting to roll over. When those roll over, the entire market's going to roll over, and that's where we look to profit on that. Okay, guys, that's all I got for today. So I'm going to wrap up. Drop me a thumbs up. Check out the course. Good value there for you guys. And I will catch you guys tomorrow.